Okay, let's look at the GAAP rules then for determining how much income tax needs to be reported in the financial statements every year. ASC 740 is the rule number that provides all of this information. It used to be called FAS 109. And collectively, the income tax number on a tax return on an income statement is called the income tax provision. So this rule basically says we have to follow the matching principle. And that's to say all the effects on a corporation's income tax expense number that were generated this year because of actions that happened this year need to be reported in this year. So what that basically means is you're going to have two components to our total income tax expense or total income tax provision. You're going to have a current piece, which is the amount that a company expects to pay this year to the government, and a deferred piece. And that deferred piece is defined as how much money, how much tax do you expect to pay to the government in future years because of something that happened this year. Now, the only reason why this even exists or this possibility even exists, is because of the temporary differences that we talked about earlier in the chapter. If you've got a temporary difference that originates this year and it's going to reverse in a future year, then if you reduced your current year taxes for that item, then you're likely going to have to increase a future year tax amount for that item. That increase in future taxes caused this year has to be reported this year. That's the basic idea behind deferred taxes. And this, as soon as I can get the mouse to move here, this chapter, let's see, where am I? This chapter goes through defining the current tax expense and also the deferred tax expense. Now, in calculating the current tax expense, here's a simplified approach. You have pre-tax book income, and then differences between book and tax methods of accounting that we discussed earlier. This is permanent and temporary differences on this line. There can be adjustments in both directions. After considering those, you've got taxable income. Before NOLs, this is net operating losses. Sometimes you're allowed to use losses from a prior year to offset income tax in a succeeding year. So if you have any carry forwards of losses from previous years, you can subtract them out here and arrive at taxable income. A tax rate is applied and a current tax expense is derived. Okay, but this is only after you've converted financial statement GAAP income to taxable income. And those differences are only because of temporary and permanent differences that were discussed earlier. Okay, so you can arrive at a current tax expense this way. That's what's paid this year. You could also have a benefit, a current tax benefit, if you expect to get money back this year. So you have losses, and you get to use losses against tax you've previously paid. You can get some of that tax back. The deferred tax expense or benefit is discussed right here. There's a balance sheet approach taken by ASC 740, and basically this, you're going to have to kind of read through this and try and make it make sense to you. Keep in mind, though, that deferred tax liabilities or assets, they only exist because something happened this year that is going to reverse in a future year. And because of the matching principle, we have to record the effect of that future reversal in the current year. Okay? There's some situations where deferred tax liabilities are created, and there's also coming up some situations where deferred tax assets are generated. I'll talk through this example in the next slide, next video.